Hey everyone, and welcome back to the Deep Dive. We're diving deep today, especially for all you CFA Level 2 candidates, into equity valuation applications and processes.
That's right. We're going to untangle some of these valuation concepts, explore how to actually apply them, and, we'll touch upon how to dissect those sometimes overwhelming financial reports.
All right, so let's start with the basics here. What does value actually mean when we talk about investing?
Well, it's easy to just look at the stock price on your phone, but as investors, we have to go beyond the surface level and look at intrinsic value.
Intrinsic value, that sounds like a big deal. What is intrinsic value? Is it all about the numbers?
It's certainly a key part, but it's not just plugging numbers into a formula. Market price is what we see on the screen, reflecting the market, but intrinsic value is what we believe the company is truly worth.
So it's about separating the signal from the noise, the hype from the reality.
Yeah.
And that's how we find investment opportunities, right? When market price and intrinsic value don't match.
You got it. That's where things get interesting. A difference between market price and intrinsic value might mean the market's mispricing the asset.
Interesting. So what are some examples of this mispricing in action?
Back in 2000, Intel announced that their revenue growth was falling short.
Oh, yeah, I remember that.
Investors were panicking. The stock price fell almost 30% in a matter of days.
Wow. 30%. What happened? Was that justified?
An analyst named Cornell analyzed the situation and found that it was an overreaction.
Really?
Yeah. The price drop pushed Intel's valuation way below what it should have been.
So people who didn't panic could have gotten a good deal.
Right. This highlights the importance of not getting swept up by market sentiment and focusing on the fundamentals.
Makes sense. But let's get practical. How do we determine this intrinsic value?
Well, the first step is understanding the business. We need to look at industry dynamics, competition, and of course, the financial statements.
So the numbers, ADN, the story behind the numbers. How does the industry a company operates and play into its valuation?
Think of it like this. Each industry has its own life cycle, its own risks and opportunities. You wouldn't invest in a company making pagers now, would you?
Huh. No way. So knowing the industry trends helps us anticipate the future.
Right.
What about competition? How do we figure out who's winning?
Porter's 5 forces can help. It helps us understand competition by looking at things like rivalry, new entrants, bargaining power, and substitutes.
Porter's 5 forces, the classic. How would we use this in the real world?
Let's compare two big oilfield services companies. One might have higher profit margins and more revenue per employee because their costs are lower and they're more competitive.
So we're not just looking at revenue or market share, but how they actually operate.
Right. And remember, it's not just about the hard numbers. Things like management quality, brand strength, and intellectual property matter too.
Reading between the lines. Got it. Now let's move on to financial statements. What are we looking for when we open those reports?
We want to assess the quality of earnings. Are they sustainable? Are they backed by cash flow? Or are there warning signs?
Quality of earnings. That's a good point. How do we assess that?
Think of us as financial detectives. A great place to start is comparing net income and operating cash flow. A large difference might be a red flag.
So it's not just about the profit they report, but how they make it. What are some other red flags?
Aggressive revenue recognition practices. That's when companies book sales before they've actually earned them, like Tango Inc.
I've heard of them. What happened?
They got in trouble with the SEC for improperly recognizing revenue. They were making their finances look better than they actually were.
Ah, so they were cooking the books.
Another example is Livent, the theater company.
Oh, yes.
They capitalized pre-production costs, making earnings look good in the short term, but it wasn't sustainable.
So how can we protect ourselves against these tricks?
We need to carefully examine a company's accounting policies, look for inconsistencies, and be skeptical.
Be a detective. That's good advice.
Mm-hmm.
All right, once we've done all that, what's next?
It's time to select the right valuation model.
Is there one perfect model?
Unfortunately, there isn't. It's about using the right tool for the job. We have absolute and relative valuation models.
Okay, break that down for me. What's the difference?
Absolute valuation models, like the DCF, pinpoint a company's intrinsic value based on projected future cash flows.
Looking into the future. Got it. What about relative valuation?
That's where we compare companies using multiples like PE or EV/EBITDA, like judging a beauty contest.
So if a company has a low PE compared to others,
It could be undervalued, but remember, it depends on the benchmark we use.
what about companies with different business segments? How do you value those?
We use sum of the parts valuation. We break the company into pieces, value each one, and then add them up.
Makes sense. What about this conglomerate discount?
That's the idea that companies with many unrelated businesses might be undervalued by the market.
Why would that be?
Some say they're less efficient, others say they make bad acquisitions, some even say it's a measurement error.
So a bit of a mystery then.
Yeah.
But choosing the right valuation model comes down to.
Understanding the company, its industry, and what we're using the valuation for.
It's about being flexible. So we've done our analysis and have a valuation. Now what?
We need to do sensitivity analysis. This means testing what happens to our valuation if our assumptions change.
Like a stress test. What factors do we test?
Things like growth rates, discount rates, and costs. For example, we might see how a competitor's new product affects a tech company's revenue.
So we're not taking our initial valuation for granted, but seeing how it holds up. What about those situational adjustments?
Sometimes we have to account for things not captured in our initial valuation, like control premiums, discounts for illiquidity or lack of marketability.
Okay, let's unpack that. Control premium sounds interesting.
It's the extra amount you pay for a controlling stake. Imagine having the power to appoint the board and make major decisions.
So a premium for the keys to the kingdom. What about lack of marketability discounts?
Those apply to shares that aren't publicly traded. They can be harder to sell quickly, so they're worth a bit less.
Like owning a rare antique.
Yeah.
And illiquidity discounts.
Those are for stocks that are publicly traded, but not traded often. Selling a lot of them can be tough without pushing the price down.
It's all about understanding the market. So we've got control premiums and discounts. What's the final step?
It's time to decide. Buy, sell, or hold.
The big decision. But we can't just say buy or sell, right? We need to explain why.
Absolutely. We need to explain our reasoning clearly and build a strong investment case.
So it's about connecting the numbers to the narrative. Let's take a quick break and recap what we've covered so far.
We've talked about intrinsic value, understanding the business and industry, analyzing financial statements, and different valuation models and adjustments.
Wow, that's a lot.
And stay tuned for part 2, where we'll dive into relative valuation and those all-important multiples.
Welcome back to the deep dive. We're putting on our detective hats and getting into relative valuation, comparing companies using multiples.
Yeah, it's like a shortcut to see how a company's valued compared to others.
Makes sense. But how do we even choose the right multiple? There are so many.
You're right. We've got PE, PB, PS, EV/EBITDA. Each one has its own use, depending on the company and industry.
Can we quickly go over when we'd use each one?
Of course. PE is a classic. We use it for mature companies with stable earnings. It tells us how much investors pay for each dollar of earnings.
Okay, earnings focused. What about PB?
That's good for companies with lots of assets, like banks. It compares market value to book value, which is basically assets minus liabilities.
So PE is earnings, PB is assets. What about PS?
PS is helpful when earnings are inconsistent or negative. We just look at market cap compared to revenue.
Got it. And lastly, EV/EBITDA.
That's a really useful one for comparing companies with different debt levels. It looks at both debt and equity.
So we pick the multiple that fits the company. What if we find a company trading at a discount compared to others? What should we do?
Don't get too excited just yet. We have to figure out why there's a discount. Is it a good reason or a bad one?
Right, like a sale at a store. Got to make sure it's not damaged goods. So what are some reasons for a discount?
Sometimes it's just short-term problems, maybe supply chain issues or a dip in demand.
So the market might be too focused on the short term.
Exactly. That creates opportunities for those who see the long-term potential.
What about when the discount is a bad sign? What should we watch out for?
Look for bad management, shady accounting, or tons of debt. Those are all big red flags.
Red flags. Noted. Now let's switch gears a bit. How do we, as analysts, communicate all this? We've done the analysis. Now what?
Time to tell the story. We need to put it all into a research report that makes sense.
So more than just numbers, we need to create a narrative.
Yes. A good report is like a great meal. Timely, well-researched, and clear, with good evidence and recommendations.
Building a bridge from the numbers to the reader. Any tips on making a report stand out?
Know your audience. Are they big investors, everyday people, or someone else? We need to adjust how we write for them.
Makes sense, tailoring it for the right person. Once we know the audience, how do we structure the report?
Key takeaways first, use visuals, and keep it simple. No one likes reading jargon.
All right, keep it clear. So we've got the audience, the structure, the data. How do we make the recommendation?
We base it on our valuation. Undervalued, maybe buy. Overvalued, maybe sell. Fairly valued, maybe hold.
Easy enough. But we have to give more than just buy or sell, right?
Of course! We need to explain why, point out the risks, and be honest. No one can predict the future perfectly.
Honesty is key. Speaking of, what's the impact of an analyst on the market?
We play a big role. We help people make investment decisions, keep the market efficient, and make sure companies are doing right by their shareholders.
Big responsibility.
Yeah.
And CFA charter holders have a strict code of ethics too, right? How does that affect us?
It's super important. We have to be competent, honest, and objective, always putting our clients first.
No funny business. Trust is everything.
Sure.
So as we wrap up this part on relative valuation, what are the key takeaways?
Remember that choosing the right multiple is important. Figure out WHY a company is discounted or not, and tell the story clearly.
Great advice. Aspiring CFA charter holders, practice your skills, stay curious, and don't be afraid to question things. Welcome back to the deep dive for the final part of our journey into equity valuation. We've talked theory. Now let's see how it all works in real life with some case studies.
Sounds good. Let's jump right in. Let's go back to Intel. Remember the stock price plummeting when they announced slower revenue growth?
Oh yeah, the market overreacted.
Exactly. Analyst Cornell used a DCF model and found that Intel was actually undervalued.
So he saw a buying opportunity that others missed.
Right. This shows how powerful a DCF can be. By projecting future cash flows and discounting them, he found a different value than the market.
It's like the market got scared and Cornell kept a cool head.
Yeah, a good analyst can see past the short-term noise.
Okay, so DCF can help spot those mispricings. What about an example using relative valuation?
Let's say there's a company called Green Tech Innovations. They make solar panels. They're growing fast, but losing money because they're investing so much in R&D.
A classic growth company.
Right. Using PE wouldn't make sense here because they have no earnings yet. We'd look at price to sales instead.
So we see how much investors pay for each dollar of revenue.
Exactly. We can compare green tech to similar companies, even if they're not profitable yet.
So relative valuation helps us understand how the market sees their growth potential.
Yes. But we always have to look at the bigger picture too. Competition, the industry, and any risks.
Right, it's all connected.
It's about combining the numbers with our judgment.
As we wrap up, any final thoughts for our listeners?
Remember, market price and intrinsic value are different. The market can be emotional, but intrinsic value is based on the company's fundamentals.
Don't just follow the crowd.
And make sure you understand the business, not just the numbers.
Be a detective.
Right. Don't be afraid to question your assumptions and use different valuation methods.
Great advice. For all the CFA candidates out there, keep learning and stay curious.
There's always more to learn in the world of equity valuation.
Absolutely. And with that, we'll wrap up our deep dive into equity valuation. Thanks for joining us, and we'll see you next time.